I believe all of you can see me now. Yeah, I can see the chat box also. Friends, sorry for the last minute change, friends. I was not keeping well. I had fever. So I actually just intimated Shetty sir that I might not take class today morning because I'm not keeping well. But then I slept off and I couldn't respond to him. So since he didn't get a reply from me, he presumed I will not be well in the morning also and he kept off another class. That's how we missed out today's class, friends. I'm still not fully recovered, but I was in a manageable position to take class in the morning. So now today's class is on standard costing. I'll go a little slow, friends, because I'm not keeping that well. If you don't understand anything, just let me know. So I will slow down further and I will take it for all of you. All right. So just tell me where we stopped at standard costing in the previous class. Did we do material, labor, variable overhead is also done, right? Okay. Today we'll do fixed overhead and sales variance first. Everyone write down the next concept heading. Fixed overhead variance. All right. In order to explain this, we will go back to the example of double omelette. Tell me, my dear friends, who is the great person who is making double omelettes? Anshuman. Now, friends, Anshuman has become an expert in double omelettes. So he's now planning to set up his own business on double omelette. All right. So that time he's confused. He is having two shops with him. One is a small shop, other one is a big shop. In small shop, the rent was 5,000 rupees. Here, he can produce an output of 5,000 double omelettes in a month, right? In the big shop, the rent is 10,000, but there he can produce and sell 10,000 double omelette. So tell me, friends, what is the rent per unit that you get over here? 1 rupee per unit. This 1 rupee per unit is what you call it as absorbed overheads. The logic is if I'm paying a rent of 10,000, I am making 10,000 double omelettes. That would mean for every one double omelette I make, I am paying a rent of how much? 1 rupee per unit. Everybody clear so far? Fine. So once we put up this table, okay, I'll just draw a table over here now. Particulars, budget, actual. Okay. Before that, Anshuman can go for small shop or Anshuman can go for the big shop. Tell me, friends, which shop will Anshuman decide to take? Will he decide to take the small shop or will he decide to take the big shop? He passes small. Anshuman says small. All right. Initially, Anshuman says small, but let's assume that Anshuman is a risk taker in my example. Right. So what he will do is this fellow will tell that why to simply think small, just like Swapna just now mentioned, think big. So he will go for the big shop. So now tell me for the big shop, how much rent he is supposed to pay? 10,000 rupees. What is the output that he is expected over here? 10,000 units. All right. So what is the rent you get per unit over here? You get 1 rupee per unit. Tell me, friends, what is the normal time to make one double omelette? Is it 5 minutes? That's what we told earlier, right? So, friends, in order to make 10,000 double omelette, the time required will be 833.33 hours. Am I right? So, if I am absorbing rent based on hours, it will turn out to be 12 rupees per hour. Am I right? Now, this was supposed to be the scenario. Unfortunately, the actual output that Anshuman could achieve turned out to be only 5,000 double omelette. Everyone tell me, if 5,000 double omelette is what Anshuman is supposed to go for, how should he have gone for the big shop or the small shop? He should have gone for the small shop. Had he gone for the small shop, how much rent he would have paid? how much rent he would have paid? He would have paid only 5,000. But now he ends up paying how much rent over here, friends? 10,000. Forget 10,000. What happened is, while he was trying to make this double omelette, etc., some people were playing cricket outside his place. Okay. One fellow who thought of himself as Virat Kohli give a big shot, and the ball came and hit Anshuman's window. The window broke. Now tell me, friends, who will be responsible to pay for the window? The young Virat Kohli or Anshuman? Anshuman, that fellow ended up paying 11,000 rupees as rent. 10,000 rent, 1,000 rupees for the glass. Output also 5,000. Now tell me what is the actual rent per output that Anshuman has got? Do you get the answer as 2.2 rupees per unit? Correct. And the actual time taken, sorry friends, for 5,005 minutes, it should take 416.67 hours. Okay. So here you will get the answer as 26.4 rupees per hour. This is overhead absorbed per hour. This is overhead absorbed per unit. Can you write down this in your books, friends? Sorry. The last slide. Uh, it is not raining. What happened? Is there some disturbance? 1 minute, 1 minute. One moment, friend, 1 moment. No, 1 minute. I didn't follow. Is everything okay? All right. All right. Hold on. 1 minute, 1 minute. Sorry, friends. Are you all done writing this? I thought there was some noise disturbance over here. Sorry. My son has holiday today. Are you all done writing this? I traveled to Chennai yesterday, Darshana, and I'm not used to the AC trains. And those idiot fellows put temperature at such a level that you feel like you are in some Manali or Ladakh or something like that. Whole night, 2 nights in a row, I had to travel, so that created the stress. I believe. I don't know. Please write down this in your books. Yesterday night, my voice was completely gone. I thought no way I could take class today. Better now. Please write down this also in your books. Sorry. Are you all done writing this? I assumed it to be 5 minutes. Was it 10 minutes? Okay, I thought it's 5 minutes was the standard time. Here we'll keep it as 5 minutes. Okay, assume this is a new double omelette shop with some better quality double omelette. Gokul, if he becomes an expert, he should take lesser time. Yes, exactly. Learning curve. He's now become an expert in making some wonderful double omelets. What you said is right. That's fine, Manoj. Today we are doing standard costing. You can also cover it up. Anyways, the recordings are available. You don't have to worry at all. And any one of you friends, when you go through the recording, you have any doubts, you can always WhatsApp me. Okay. I'll reply maybe in a span of maximum 24 hours. Okay. Live interaction you miss, Manoj. I can't help that now. Are you all done writing this now? Malvika, I don't think there is any number of limits. Okay. You try watching one class 2 to 3 times, then you will come to know automatically, right? I doubt there is any limit. That's even better. Pen drives will have a 2.5 times limit, right? Ashwini, I've given it over there. 10,000 units into 5 minutes divided by 60 minutes per hour. Are you all done writing this? All right. Now, everybody interact with me. Okay. SQ is based on actual output. SH is based on actual output only, right? So here also we have to find out the standard cost and we have to compare this with the actual cost, correct? What is the actual cost that we have got? 11,000. How will you compare the standard cost now? Will you take the standard cost based on 10,000 units or will you take standard cost based on 5,000 units? You will take it based on 5,000 units multiplied with what? Multiplied with standard price. What is the standard price? 5,000 units into what? 1 rupee per unit. That is the standard rent per unit. Am I right? Okay, wonderful. Okay, so here you will get the answer as 5,000 rupees is the standard. Actual is 11,000. What is the difference that you get over here? 6,000 adverse. Okay, just give a point over here because SQ is based on actual output. Okay, please write down this in your books now. Shiv Shankar, I'll explain once again. Just write down this. Okay, just write down. I'll explain this once again to you. I'll repeat once again. Shiv Shankar, can you please unmute yourself so we can interact and we can learn it better? Just raise your hands. Shiv Shankar, can you hear me? Shiv Shankar, what was the budgeted output of double omelette that we were planning for? 10,000, correct? But in reality, did we produce 10,000? Only 5,000 we produced, correct? Now tell me, SQ is based on what? Actual output. So here, what is the actual output? So we'll take 5,000 as the actual output. This you will multiply with the standard rate. So you will get the standard cost. Am I right? We do normally, what do? We do SQ into SP is what we do normally, correct? All right. And then I told you that SQ is based on what? Actual output, correct? So now tell me what is the standard rate? 1 rupee. So if I do 5,000 into 1 rupee, what is the rent that I'm getting over here? So that turns out to be your standard cost. What is your actual cost? 11,000. So what is the deviation that you're getting over here? Are you clear with this part now? I will tell the logic in a different manner now. Everybody interact with me. Shiv Shankar, you can, cancel your request. Everyone interact with me now. All right. Anshuman had two options. What were the two options? Small and big. All right. For 5,000 units, what would have been a correct option? Small would have been a correct option. If it was small, how much rent he would have paid? 5,000. Now, actually, how much rent he ended up paying? 11,000. So, how much is the extra rent that is paid from his hands? 6,000. That is exactly the same thing that we have got over here. Are you clear now? I'll write down. Anshuman has two options, big or small. He opted for big and thought he could sell 10,000 units. But he sold only 5,000. Had he known this earlier, he would have gone for small shop. In which case, in which case he would have paid only 5,000. Now he paid not 10k, 11k, including the glass damage. Total loss 6k. Write down this in your books now. Oh. Are you all done writing this? All right, friends, I'll go to the next part. Now I'll give you the table format for fixed overhead variance. So I'll draw a variance table. First part will be AO into SRU, AFOH, BFOH, AH into SRH. All right. So actual output is 5,000. SRU is 1. You get 5,000. All right. AFOH is 11,000. Budgeted fixed overhead. BFOH is budgeted fixed overhead is how much? 10,000. AH into SRH. What was the actual hours? 466.66 hours. Multiplied by standard rate per hour was 12 rupees per hour. Logic, I will tell you. First, let's complete writing this. You'll get the total as 5,600 rupees over here. All right. Once you do this, I'll draw the table also. First one will be 1 minus 2, which is called as cost variance, which will turn out to be 6,000 adverse. Inside this, you have got fixed overhead expenditure variance. That will be 3 minus 2 as usual. 1,000 adverse. This 1,000 is nothing but what? Tell me the logic of this 1,000 adverse. What is that 1,000 rupees? The glass. Wonderful. Expenditure went up by 1,000 because of the glass breaking. Wonderful. 1 minus 3 is called as volume variance. That will be 5,000 adverse. What is this 5,000, friends? Small shop rent versus big shop rent, assuming the glass was not broken. Are you clear with that? Inside this, just by heart, you are having capacity variance, that is 4 minus 3. And last one, they call it as efficiency variance, and multiple names they use over here. Yeah. So this part is again the balancing figure. You don't have to worry much about this. How much is that? 1, 4, 4 minus 3. That will be 4,400. I think it's favorable, right? 1 minus 4 will be 600. No, it's adverse. 4,400 adverse. 4 minus 3 adverse. And here it will be 600 adverse. Just write down this, then I'll tell you the logic. I'll give you in writing because this is the only tough part in standard costing. Yes, is it 416? Did I make a mistake there? Is it 416? Sorry, friends, I made a mistake over here. That will be exactly 5,000. Oh, okay. You get exactly 5,000. So what happens? Then it will be 0. 0 over here. No, not 0 over here. 5,000 minus 10,000 will be 5,000 adverse. Full will come on capacity. And this one will become 0. Okay. Please write down this in your books now. Are you all done writing this? Are you all done? I believe everybody is done writing this, friends. Now I'll give you the logic. Okay. First one will start with AO into SRU. Not done. Wait, let everyone finish. I hope I'm audible to all of you, right? There is no problem over there, right? Yeah. All right. Fine, friends. I believe everybody is done now. Okay. Yes. Anshuman, all good. AO into SRU. All right. Now let's do this part. AO into sorry. AO into SRU. What is AO? 5,000 units into what is standard rate per unit? 1 rupee. So do you get the amount as 5,000 rupees, friends? Friends, this 5,000 rupees, can I not say this is nothing but the absorbed fixed overheads? Yes or no? This is the absorbed fixed overhead based on units. So we are absorbing the FOH based on the amount of units. Point number two, AFOH was 11,000. This is nothing but actual fixed overhead. Everyone tell me now, if I do absorbed fixed overhead minus actual fixed overhead, I will get under absorbed overheads or over absorbed overheads. Have you learned this part in your class, friends, in your inter-level classes? Yes or no? Yeah. So now tell me here, is it under absorbed or is it over absorbed? Overhead incurred is 11,000. Absorbed is only 5,000. Is it under absorbed or over absorbed? Here it is 5,000 under absorbed. Everybody clear with this? So this under absorbed is a loss, over absorbed is a profit. I don't know if you remember, under absorbed we used to transfer it to costing P&L account. If you remember this in your inter costing, it is a loss. So friends, whenever it is under absorbed, under standard costing, we will get adverse variance. I will repeat again, Anaka. If it is over absorbed, we will always get favorable variance. Anaka, can you please raise your hands and interact with you and explain to you? Anaka, can you hear me? Okay. Anaka, now tell me, point number one is how much? What is the amount given in point number one? What is that 5,000? Okay. You're clear that it's absorbed because only we produce 5,000. For each of the units produced, 1 rupee is the rent absorbed. Am I right? Correct? Correct. But unfortunately, what is the actual overheads incurred? 11,000 is incurred, but I could absorb only 5,000. Am I right? So have I absorbed more than 11,000 or less than 11,000? So if I absorb less than 11,000, is it under absorbed or over absorbed? Exactly. That's for exactly what I've got over here. Under absorbed. Did you see this? Okay. All right. So now under absorbed overheads. Yeah. Tell me. 5,000 minus 11,000 will give you negative answer. If you want, you put it as 11,000 minus 5,000. I'm okay with that. Nothing wrong. I'll show you the journal entry. I don't know if you remember the cost accounting systems chapter in your inter. There was an entry called as overhead control account debit. First, it will come to 11,000. Okay. To general ledger adjustment. Do you remember that ledger? Okay. Now what happens is out of this only 5,000 is absorbed. So only 5,000 will go to work in progress. So the second entry that you must have learned is WIP account debit to overhead. That will be only 5,000. Remaining will be P&L account debit to overhead. That will be how much? 6,000. So basically this is overheads incurred. Okay. This is overheads absorbed. And this difference is what we call it as under absorbed. Are you clear now, Anagha? I'm speaking to Anagha, right? Yes. Okay. So under absorbed is always adverse. Over absorbed is always favorable. Are you clear now? Oh, okay. That's where you must have got confused. Sorry, Anagha. It is 6,000 under absorbed. Yes. Okay. Thank you. Thank you. Please write down this in your books now, friends. One moment, friend. Wait. Not done? Is that the reason you raised your hand? My son is in full form today, friends. School days used to be wonderful. We used to enjoy on Saturdays. Now Monday to Sunday looks the same, friends. Can I go to the next page? Okay. Everybody done writing this, friend? Let everyone finish. Deepak, your kids are dancing with full josh, high volume. Weekend is the occasion. Even the IT fellows in Bangalore have a lovely time here. They have the complete weekend off. All right, I believe you're all done writing this, friends. Can I go to the next part? I believe everybody is done writing this. Okay, so I taught you about first one, AO into SRU. So I'll just write down again over here. AO into SRU is nothing but absorbed fixed overhead, correct? Second one was what? AFOH was what? This was actual fixed overhead. Third one is what? BFOH. What is BFOH? Budgeted fixed overhead. Now you tell me what is AH into SRH? What is AH into SRH? This is also absorbed fixed overhead. Okay. But the only difference is the first one is based on units, the second one is based on hours. Friends, do you remember labor hour method, machine hour rate, etc. etc.? Overheads can be absorbed using multiple things, and that's what makes costing very, very confusing. You can absorb the same thing based on units, you will get a different answer. Based on hours, you will get a different answer. Luckily, in our case, we got 5,000 as absorbed based on units, and we again got 5,000 as absorbed based on hours. That is because I kept the time same. If the time was different, we would have got a different answer altogether. Are you clear now? Please write down this also in your books now. Yes, Manoj. Everybody done writing this? All right, I'll go to the next part now. So we are done with this four things. All right, now I'll teach you 3 minus 1. What is 3 minus 1? So sorry, 3 minus 2. This was expenditure variance. Correct. So what is the formula for expenditure variance? Budgeted fixed overhead minus actual fixed overhead. This was turning out to be 10,000 minus 11,000. We got the answer as 1,000 adverse. Correct. Or we thought that the rent would be 10K, but since glass broke, it went up to 11K. This is the extra expenditure over the budget. Please write down this also in your books now. All right, friends. Are you all done writing this? All right, friends. Everybody clear with this part? Can I go to the next one now? This is all about the expenditure variance. Last one is what? Volume variance. Beyond that, it is of no use to learn. Okay, so what is the formula for 1 minus 3? This is what you call it as volume variance, or it will be budgeted fixed overhead minus, uh, sorry. It will be AO into SRU minus BFOH. Friends, I'll just elaborate on one point over here. BFOH can also be mentioned as BO into SRU. Everyone tell me what is the meaning of BO? Budgeted output into standard rate. So for example, all right, I'll just put it over here and show you. Budgeted output is 10,000 into 1. That is how you get 10,000 rupees. Here it is 5,000 into 1. Are you understanding my point? So that is how you get the answer as 5,000 adverse. If I look over here, can I not say that the common factor over here is SRU? SRU into AO minus BO. And that is exactly how you get the answer as 5000 inverse. Or the logic goes like this. My standard rate per unit is 1 rupee per unit. We thought we will produce, we thought we will produce how much? We thought we will produce 10,000 units, but actually we produced how many units, friends? We produced 5,000 and hence there was a volume difference of 5,000 units into 1 rupee, which is equal to 5,000 adverse. Everybody clear? Can you write down this in your books now? Hold on, Shivshankar, you want this slide, is it? Previous means this one. Okay. Please write down the logic now. Are you all done writing this, friends? I believe everybody's done writing this. So we are done with this part. Okay, I'll go to the next one now. So we are done with the fixed overhead variance logic also. Everybody's clear so far? Last one, sales variance. This one is easy now, friends. The main tough area was fixed overhead variance. The table format is BQ into BP, AQ into AP, AQ into BP, RAQ into BP. All right. So now tell me, friends, BQ means what? Budgeted quantity. Everyone tell me. SQ is based on actual output. SH is based on actual output. But friends, for sales, you will never have a SQ. Why? Can you tell me? Have you ever heard a salesman telling normally a normal human being can sell this much of omelets? Sales is something which is always based on targets. You can never have a normal sales. So it's always based on what? It is always based on budget. BP is what? Budgeted price. AQAP you must have understood. So here if I do 1 minus 2, what will be the name for this? It will be called as sales variance. 3 minus 2 will be called as price variance. 1 minus 3 will be called as volume variance. Then you will have mix variance, that will be 4 minus 3, and 1 minus 4 will be yield variance. Okay, can you write down this also in your books? Somebody has a doubt? Ashwini?
Yes, sir. Am I audible?
Yes, Ashwini, you're audible. Tell me.
The fixed overhead variance also. Why did we consider the budget on this, sir?
In the fixed overhead, see, I'll explain to you. 1 minute. If you see, here and here we have concerned only standard versus actual. Did we take budget? No. The first one is this is standard, right? AO is based on, so SH is based on actual output, right? Wait, 1 minute. Okay, I'll just draw a fresh table and show you. First, we'll write AO into SRU. Then we have AFOH. Then we have BFOH. AH into SRH, right? This is what, is this, Ashwini, is this standard or is it budget?
That is standard.
This is standard. Why? Because it's based on actual output. Am I right? Correct? This is standard. And what about this? This is
Actual.
after this is what? This is our main cost variance. Am I right? Okay.
Yeah.
This is only a breakup in the main cost variance. Right or wrong? See, first we got 5,000 adverse. Sorry, we got the answer as 6,000 adverse. Okay. Inside the 6,000, 1,000 adverse was one variance, 5,000 adverse was another variance, right? This is basically nothing but the breakup of 6,000. Am I right?
Yes.
Right? So this is not, this 6,000 is the main variance. So while taking the main variance, did we consider budget? But while we took the breakup, how the main 6,000 has come, in that breakup we have taken budget also and the actual also. Am I right?
Yes.
Ultimately, what is relevant is the main variance. Inside is all just the reasons for how the main variance has come. But when we do the sales variance, okay, we start with budget.
Yes.
So here the main variance by itself is what? It is budget versus actual.
Okay. So, is it like budget variance is much of budgetary control than the standard costing?
Yes, this is actually budgetary control. Sales variance is budgetary control only. You cannot have a standard costing for sales. You can only have standard for material, standard for labor, standard for overheads. You cannot have standard for sales. That's why this is budgetary control.
Okay, sir. Fine.
All right.
My only question is that begin the chapter, you were like budgetary control is the the comparison between the actual and the budget, and this is between the standard and the actual.
Correct,
So
correct.
when would the budget come in between in the fixed overhead, and here was the only concept.
Now, once you do the reconciliation, you will understand. We will not take the budget. We will take the variance. I'll come to that. For timing, this only one part we are using budget and standard costing because there is no standard for this. Just keep it like this. Once you do reconciliation, you will understand that how budgets are important in standards also. Okay?
Yeah. And basically, sales variance is nothing to do with the cost, right? So
Nothing,
it is
nothing.
only the price and the volume of sales, right?
Exactly.
Okay, okay, sir.
All right. Okay. Thank you.
Thank you.
Friends, are you all done writing this? Anybody still writing? Let everyone finish. I believe everybody is done writing this. But Darshna, for sales, you'll never have a standard. You'll only have a budget. Fine. Everybody is clear with this part. Now, listen carefully. We are done with all the variances: material, labor, variable overhead, fixed overhead, and sales. We are done with everything. Now we are going to do problems of this. Okay, do you remember material, labor, etc. what I have taught you, or do you want a 10 minutes time to revise that? Because now when we do the questions, you will do it yourself. I will not help you. I will just give you the final answer. So we'll do one thing, friends. Shall we take a 10 minutes break? We'll take a 10 minutes break. You revise the entire basics that I have taught you. Then after the break, we'll give you some time, crack all the problems and make your base very much strong. Is that okay? Fine. So we'll take a 10 minutes break, friends. One moment. Manoj? Manoj, can you hear me? You're not audible, Manoj. Yes, yes, Manoj, you're audible now. Okay. Because in lay, okay, you are basically asking that we are taking budget in case of fixed overhead. Why are we not taking it for the purpose of labor? Is what your doubt is, correct? See, fixed overhead is going on a very different level altogether. It is a very different nature. See, material, labor, and variable overhead, are they variable cost or are they fixed cost? What fixed overhead is what? It's a fixed cost, right? Okay. When you go for material labor, you don't have any under absorption, over absorption. Am I right? But in case of fixed overhead, you got under absorption, over absorption, right? Yeah. That absorption is done based on what? Budgets. That is why we consider that. Now, if you look over here, when you took the budget 10,000 versus actual 11,000, this budget is basically the real rent that we thought will come. Am I right? Okay, so that doesn't come in case of material labor because they are purely variable. They don't have any under absorption, over absorption. Fixed overhead is a complete different way of finding a variances. All right, tell me. In case of, but uh, but in case of labor, we never take the budget in the variance table. SH into SR we don't take. AFOH we don't take. Sorry, not AFOH. AH into AR we don't take. AH into SR also we don't take. RAH also we don't take. Budget doesn't come in the table. That's only the data that is available with you. Correct. That's because there is no under absorption, over absorption there. Because ultimately, if the actual is less, you take only the actual. But in case of fixed overhead, if the actual is less, you will have under absorption, over absorption. So budgets affect the fixed overhead. It does not affect the labor. Got it? All right. Fine, friends. Let's take a 10 minutes break now. Okay. After that, we'll continue. Thank you, friends.